Welcome to The Explainer. Today, we're going to tackle a huge concept, one that's absolutely critical for making smart moves, whether that's in business or in the financial markets. We are talking about leading versus lagging indicators. But before we get into the nitty-gritty, let me ask you something. Think about driving a car. To get where you're going safely, what's more important? The windshield so you can see what's coming up, or the rearview mirror so you can check what you've left behind? I mean, the answer's pretty obvious, right? You absolutely need both. And believe it or not, that is the perfect analogy for what we're digging into today.
All right, let's jump right in. We'll start with that rearview mirror, which, for our purposes, is all about lagging indicators.
So a lagging indicator, well, the name kind of gives it away, doesn't it? It lags. It measures something that has already happened. It's the result, the final score, a little piece of history. You know, some sources call these output metrics because that's exactly what they are, the output of stuff that's already finished and done.
So what does this actually look like in the real world? Well, in business, a classic example is your monthly revenue. It's a hard number, it's in the books, done. On a much bigger scale, you've got things like GDP or the unemployment rate. We see those headlines all the time, but they're telling us about an economy that was. Or think about a construction site. The number of accidents last month, that's a lagging indicator. A support team's average ticket resolution time, same thing. See the pattern here? They're all super accurate, they're pretty easy to measure, but they are all looking backward. They just confirm what's already happened.
All right, so if that's the rearview mirror, what about the windshield? Well, that's where leading indicators come in. These are the things that help you see what's coming up ahead. So let's flip our focus and see how these can help us predict the future. Okay, so a leading indicator is totally different. It's predictive. It's all about tracking the inputs, the actions you're taking now that you hope will get you the result you want later. Now look, they don't guarantee anything. It's not a crystal ball. But what they do give you is an early warning system, a chance to course correct before it's too late. And this is where the difference really clicks. Instead of waiting for that final lagging sales report at the end of the month, you could track a leading indicator, like how many sales calls your team is making every single day. Or instead of just counting accidents after they happen, you could track the percentage of people actually wearing their hard hats. You see, that should lead to fewer accidents. In the financial world, a big one is new housing starts. That can give you a pretty good idea of where the economy is headed. It's all about tracking the inputs, the actions that give you a hint of what's to come. Okay, this all makes sense for a single business, right? But what about analyzing the entire market? Well, turns out the exact same logic, looking forward and backward, is just as important. So let's just nail this down. Lagging indicators, they are all about output and confirmation. They tell you, hey, this trend definitely happened. But leading indicators, they're about input and anticipation. They whisper, hey, a change might be just around the corner. You know, the analyst Dave Keller put it perfectly. He said that in the financial markets, all the tools you have are designed to do one of two things: either anticipate a move or confirm it. Okay, this is where it gets really interesting. Let's look at how this plays out on an actual trading chart, because this is where theory becomes practice. So picture this. Step 1, you've got a clear uptrend. Maybe it's Bitcoin, doesn't matter. The price is just climbing. But then, look at step 2. Something weird starts to happen. Even though the price is still inching up, a leading indicator like the RSI starts making lower highs. This is called bearish divergence, and it's a classic warning sign that this rally is running out of steam. It's your windshield flashing a warning light. So what happens next? Step 3, the price itself starts to wobble. But, and this is so important, it takes a ton of patience. You don't just jump in based on that clue. That's just a guess. No, you wait for step 4, the confirmation from a lagging indicator. This could be something like a moving average crossover. Boom. That's your confirmation that the old trend is dead. Your rearview mirror is now telling you that uptrend is officially over. That 1-2 punch, a leading clue followed by lagging confirmation, is what traders call confluence, and it's everything when it comes to managing risk. You never act on one signal alone. So this all comes right back to our driving analogy, doesn't it? I mean, you would never, ever cover your windshield or tear off your rearview mirror. The real power, the true insight, comes from using both of them together. Think about it like this. A leading indicator all by itself? It's just a guess. A good guess, maybe an educated one, but still a guess. Let's say you're tracking how many people add something to their online shopping cart. That's a great leading metric. But it's just a hypothesis. It's not a sale. If you start making big decisions based on that alone, you're betting on intention, not the actual, hard, lagging result of money hitting your bank account. And flipping that around, what if you only have lagging indicators? Well, then you were literally driving by only looking in the rearview mirror. You'll get a perfectly accurate report telling you that, hey, a ton of customers left last month or that your profits tanked. But by the time you see that report, the damage is already done. It's too late. You had zero warning, no chance to step in and fix things. You're just stuck reacting to fires instead of preventing them. So the big takeaway here is that the best strategy isn't about choosing one over the other. It's about combining them. You need the predictive clues from your windshield and the factual confirmation from your rearview mirror to really navigate effectively. It's about using both in harmony. And that leaves us with one final thought to chew on. In your own decision-making, which do you find yourself trusting more? The predictive clues or the confirmed results?